Most businesses don't fail because they don't have enough customers. They fail because they misunderstand profits. Now, I'm Paul Wilson Jr.
I'm Mike Upshaw.
And this is the Profit Formula.
Today we're talking about the Fox and the Roku deal. And so we have with us none other than our financial specialist in the space. And he is going to help us break this deal down and talk about, what it looks like. None other than James Peterson. And he was on the show where we talked about strategy and business strategy. And so we thought, man, let's talk about this as a strategy and what it looks like when you are in the middle of, your success. Well, Roku is probably a whole lot further than in the middle, but what it looks like is they started, right? They got to this point, then they decided, hey, Fox was knocking on the door and they answered with a $22 billion check on the outside of that door. And so so we're going to talk a little bit about that. We're going to talk about the financial side of it, and we're going to talk about the technical side of it and what it all really looks like. And these are just our opinions, and but my background is in streaming, and so I want to talk about it as a Roku developer, potentially what it may look like for developers in the future, and all of those things. So James, welcome to the Profit Formula once again.
Yes, I'm your resident CPA. So,
there you go.
I'm always glad to join the fellas when we're going to talk some business and strategy.
There you go.
When you brought this to me, I thought it was a really interesting because I wasn't really paying attention. I was like, wait, Fox is merging with Roku? Let me go do some research on this. And I was like, that's an interesting merger. That's why I am more, interested in hearing your tech side because I'm like, I know there's a tech side to it. For me, I saw why they did it from a financial perspective because they looking to generate basically more revenue, and they see that there's some things that Roku can bring to the table for them that's like it's going to open some more revenue streams for us.
100%, man. When we look at this deal, couple things that stood out to me. Anytime I see deals like this, when it comes to a company who was not necessarily a technology company that then turns around and purchase a technology company, then you start to wonder, what is it all about? So I'm gonna go back a little bit, right, with Fox, because Fox kind of has a little bit of a history. There was a platform years ago. Most of you may remember it. It was called MySpace. And so MySpace was, it was the platform that everybody was using to kind of get their music out or, all those type of things, right? Was becoming a very popular platform. At the same time, you had the rise of Facebook and the rise of Twitter. And so Fox came along and said, hey, man, we're going to buy MySpace. I remember they announced it, they bought it, and then MySpace went into space.
I was just about to say, it just vanished at some point.
So I was like, man, what was the point? Did they buy them just to put them out of business, or did they buy really the database, right? And so now, to me, it's starting to make sense. Fox, fast forward, they launched Tubi, right? Tubi is a platform where you put, pretty much low-hanging fruit for any creator, filmmaker want to get their content on, they go to Tubi. Then I started thinking about the audience on Tubi. And then it took me back to MySpace, right? Because if you go back and look at MySpace, you probably see a lot of the same audience type, right? Which is now what's making up that Tubi, audience, right? And so, so the two things may not even be connected, but it's just the way that my mind thinks is that they were thinking about it way back then in terms of potentially what this database would do. Because they didn't just buy a company to sync it. And not, why would you just throw that kind of money at something to do nothing with it? So it just goes to show you that time, right, and technology, and when they catch up and at the right moment, Fox says, hey, we launched our platform on Tubi. We can see what it's going to do. We also have Fox, who is, traditional broadcaster. But then along the way, they see how to leverage this technology. Now, most people would say, well, why they just don't build it themselves, right? Why should you? When you already have the largest platform out there. Roku is the largest set-top box OTT platform in the world, right? So when we look at it from that standpoint, they've already invested in the technology infrastructure. They already know that they can manage all of the content and they can manage all of the viewers. So in that, now you start to see, oh, this makes sense, right? 100 million households. This technology,
global.
There you go, right? So this technology has spanned the globe. now we talk about when we look at what you can do when you get into the advertising space and the potential. Now Fox puts itself in a position to be the leader in all things, broadcast, right? In my opinion, sports. So these are the
You
things.
got sports, live streaming.
Come on.
Yeah.
And then now what Roku brings to the table.
That's it.
You got Tubi already. You combine Tubi with Roku.
That's it. And we're not even talking about what pay-per-view opportunities might exist, right? So
But then people not. But if you think about the overall, then it's because the more faces you got, the more advertisers will want
There
to
you go.
spend with you
that's it.
Yeah.
to get their products in
That's
front
it.
of 100 more million
Yeah.
people.
Absolutely.
Oh well, I'm not even saying people, just
Households and
Households.
Yeah.
Yeah.
So when we think about that, then it helps us to really start to look at the math, right? And why it makes sense.
But if you think about this, even just any merger, to piggyback on what you said,
Yeah.
why don't they build it themselves? First of all, how much would it cost for them to build it themselves?
That's it.
Right.
And not just that,
Probably more than 22 billion.
even
to
if
get the audience.
not,
Yeah.
now you got to build
You gotta
something
build an
that can
audience, yeah.
compete with an already established Roku.
Right.
So it's like, well, why am I going to spend all this money to build something to try to maybe compete,
Right.
to try to get into
Yeah.
those 100 million homes to compete with someone who's already established,
Exactly.
when I could just spend the money and merge with someone who's already established.
Yeah.
And now I'm into those homes.
And to that point, every other what would be competitor in the space has not eclipsed what Roku's been able to do. So when you think about it, if we look at, I'll use Amazon Prime, right? That's all Amazon's content, and their app on Roku's platform, right? Everybody has created apps to be on these platforms. If you think about, I'll use Netflix as an example. When Netflix had Miramax, which was kind of like when they started, it was like, hey, we're going to have all these movies and all of these things. Well, at some point, Miramax was like, well, we could do this ourselves and take all our content and we can just sell it directly to our viewers, right? The difference between a Netflix and a Roku is its platform versus one specific streaming platform, right? Roku is the streaming platform for every other streaming platform. So now
Like
you
the
have
Walmart.
It's right there. You go.
Right.
They've created what I would say what iOS did with mobile apps, right? In the same space as apps. Now, if you look at streaming apps, most people will refer to Roku because now they know what it is. So when Roku did the deal with, I think it was TCL, and Hisense, right? That put them from a set-top device into televisions.
Yeah.
So now it's like, oh, when I buy my TV, I already have Roku built into it. So I don't have to go buy a little Roku stick or anything like that. Now when I go to a hotel, I can log into my Roku account. Now, or I could pull up Roku on my phone, right? Or whatever. So now you can go into and manage all of these different things because everything is basically, you have access to it, right?
Yeah.
So now, you're going into places where you're like, okay, cool, I can access my content here. I can do all these different things. And so that's the piece where it puts you into all of these places, right? Now, from a technology standpoint, where I think Fox also wins is when you're the owner, you can kind of position your content above everybody else, right? I think that could be a shift in how they manage content and advertisers because they can just about guarantee where placement for ads are going to land and being able to distribute into these specific areas. So it makes you a very, what's the best way I can put it? They really become the shark in the ocean, right? They can kind of eat all the small fish and still yet have all the small fish on their platform.
And that was the thing I read.
Yeah.
They talked about how now all the other people will have to come to them
Yeah.
Right.
to get onto their platform
Yeah.
instead of them being just another one of those people
Yeah.
going on the Roku. It's like, no, now you all got to come to us.
Well, that's the thing. Go ahead.
No, I was going to say, and now, because I was looking at numbers. So when they bought Tubi, 2020, they're at 33 million
Yeah.
subscribers. Now they're at 100 million.
Yeah.
Right. And so Fox says they have a history now, right, of buying existing properties
Yeah.
and how do we expand them. And this is probably even more strategic than Tubi, because Tubi was just, again, another platform. Streamers, like I say, it was a unique demographic.
Yeah.
But now they've been able to see that grow. So now you come over to Roku, right, that's a whole different conversation about who uses Roku.
That's right.
Right. So now, but they've got some experience doing
Yeah.
it. now growing that subscriber base. It'll be interesting to see kind of where they take it from here.
Well, and I think to your point, because now if I'm a developer or if I have a channel on Roku, right, I need to start thinking about what does that look like, right? Now, the potential for Fox to do something similar to a YouTube, where now you partner with those content creators that's winning, and now there's a rev share type of situation. Right. That's something that I would like to see from a technology standpoint, because it will cause people to push, sort of like how Netflix started to do with podcasts now, right? They're like, wait, we see something with this podcast thing, so now you can get those same podcasts, but you're paying more to get them on Netflix. This is not part of your regular subscription. Right. So that gives them an opportunity to share that profit with the creators. So if you think about it from this standpoint, if you're winning on Roku and you already have a channel that's doing numbers, potentially they come and say, hey, we want to do this, run ads or whatever it is on your network. And we already know that it works, right? How are you making money currently versus how do you want to make money tomorrow, right? And so that's the way that I think about how you can leverage potentially the creators that's already there, right? When I remember when Roku first started and building channels for Roku, it was just like mobile apps. Remember when mobile apps first started, people were paying $10, $12, $13, $100,000 to build a mobile app. It was like that, early on in that space. After a while, you had so many, platforms come out, and developers and all these things, and it got down to pennies. So it was really not a whole lot to build it. But if you look at other platforms that launched around the same time, how often do you hear people talk about Apple TV, right? Not often at all. It failed, right? Because Apple's thing was they wanted to do a profit share with but they wanted to take way more, right? And most of the film houses was like, oh, we're not doing that, right? So, and you take those same people, they went to all these other platforms and they created their own apps, right? And so you think about the success of Apple, and if you look at the Roku brand, Roku was able to eclipse what Apple wanted to do because they were the first to the race, right? But they also did a great job with working with developers and building channels. I can name channels that we put on Roku that you've never heard about, right? But there are thousands of them. And so that's how much content exists on that platform. So when you look at what they have an opportunity to do, unlike TV channels, you never run out of a channel, right? So the scalability of it is, man, it's crazy, right? And so that's why I think that at some point there may be an option where if you're a developer or if you're a channel owner, that they'll look at what your numbers look like and say, hey, this is, what we want to do. And not to mention that you really wouldn't have a choice, because if they change their, terms and conditions, right, you're going to have to fall in line with whatever those terms and conditions are, right? And it would be foolish of you to lose the channel because they still own the database, right? So think about it. You don't own the database on these platforms that you're on. So it would behoove those who have these audiences to start thinking about, hey, how do I want to, think forward as far as growth potential and what opportunities may come, and position myself so that this becomes a revenue opportunity for me as opposed to a loss, right? So that's my take on the whole, streaming component, because you have channels that are multi-channel. You got video on demand, you have channels that can run live content, you got some people running 24-hour networks. So you got all of these different types of distribution that's happening with content that you got to come up with an answer for. Hey, how's this going to work out, right? And what is it going to look like for developers, and then how does that look for the end user, and then so forth and so on.
Absolutely.
So I can tell you another group that's very thrilled about the merger.
Who was that?
Roku shareholders. They got a 34% premium on their shares. And they actually said post-merger they will make up about 27% of the shareholders in Fox now. So they are very.
So talk about the structure of that deal, how deals like this come together, because we may hear about that stuff just in the news. Such and such company buys such and such company. Maybe a combination of stock and cash, and premium versus did they get a discount? So just kind of walk us through how you view the structure of the deal and who won from that standpoint. Yeah.
Well, they structured this deal by cash and stock.
Okay.
So I believe it was about 96 million in cash, and the rest is kind of like stock value.
Yeah.
Gotcha.
Now,
So what was the total number? Was you said 17 billion?
22 billion.
22 billion.
Yeah.
22 billion. Gotcha.
So it was like, and if you think about it, they actually had to take about $12 billion in debt to cover this whole
Get it done. Right.
this whole thing.
That's the part I want to talk about.
So it's like, and that's the thing that kind of like people was like, all right, you're incurring this extra debt. You gave them a premium price on the valuation of Roku.
Right.
We think you overpaid. So some people started bailing on the Fox stock,
Right.
which drove down the price because they was like, I don't know about this. Is this even going to be worth it? And so people was, but that was basically the structure. They gave them cash and stock. And like I said, the Roku shareholders, they came away very happy because they got a premium on their shares.
Right.
And they're now invested it. They're going to be invested in the merged entity.
Gotcha. Yeah.
One of the things that stood out to me as I was reading it, and you just mentioned it, and I think it's important because when we talk about like strategic planning, a lot of times we hear these companies like a Fox that says, hey, we're going to throw $22 billion at this company. Mm-hmm. Most people think, oh, they just stroke a check and do it. Mm-hmm. Talk about why they don't, number one, write a check, and why they would go get a loan and what that looks like. Like what, because for a lot of us who don't think on this level, right, it's like, man, somebody out there trying to get a loan for $100,000 to start a company, right? Mm-hmm. Fox is well known, got a lot of money, advertisers, all this stuff. Talk about why they would secure a loan, as we would call it debt, that they would go out and get that kind of debt.
Well, I mean, because number one, they don't want to burn through their own cash. Right. That's number one. Number two, they know they got relationships with financial institutions out there that would be willing to finance this merger. Because trust me, before any financial institution is going to even agree to this loan structure, they definitely going to want to see a lot of the legwork they did to kind of present, this whole valuation of Roku and Fox pre-merger, post-merger. Because first of all, they want to know, are they going to be able to get their money back?
Right.
But we already know Fox has been solvent for forever.
Yeah.
Right.
So every financial institution probably was running to kind of give it to them because you know why? They want to make their interest revenue.
Yeah. Right.
And they know Fox has probably been known to pay their bills on time.
Right.
So you making interest off of $12 billion, sure, we're going to give it to you.
Yeah.
So,
right.
And Fox knows this because Fox also know that in the long run, they're going to be able to pay off this debt.
100%.
But the money they plan on making post-merger, they see that kind of as it's a means to an end.
So, yeah, because in situations like that, you got banks standing in line to do that business, right? It just makes sense. And I think that's the thing that a lot of times on an entrepreneurial scale, we don't think about, right? Like what it means to scale to a level that you can say, hey, I need this much to do this deal, and it makes sense. Because I think a lot of times we don't think about those things. I was listening to a kind of a documentary type, I guess, audio version of it, where it was talking about Ebony Magazine and sort of how they, how it ended for Ebony.
I literally was watching that yesterday when I had the gym. Well, I was watching the history of the person who created Jet and Ebony Magazine and how it grew and then what caused the downfall.
Right. Gotcha. Because you think about it, I think at the close of that, they said that, they end up selling it for something like $14 million.
Yeah.
Right?
Well, someone actually bought it out of bankruptcy
for $14 million.
Because I think they ended up still only selling it for like $35 million.
Right.
And
gotcha.
At its height, it was worth a lot more.
A lot more, right? We're talking like $1 billion, organization, right? And we don't talk a lot about it, but having the right structure, having the right plan, having the right things in place, right? Because every one of these companies start with an individual who has a vision to do something. And I think that's the thing that we miss. We see Fox, right? But we don't go back to like when Fox first started. And I think that when you are planning to grow or scale any company, where you see yourself 20, 30, 40 years from now is really where you start at, right? Because it's with the vision that you start at. The difference could be, and I'll flip it, if we heard that Roku bought Fox, it would be a bigger surprise, right? Than it would be Fox buying Roku. But the fact that it got to that point came through strategic planning, right? Executing certain strategies to make sure that, hey, we can put ourselves in position, one, to be bought if you Roku. And then, because maybe day one, right, 2002 or whenever they launch, hey, yeah, we're going to grow this thing. We're going to partner with Netflix and we're going to have, content. This is what we're going to do. But now we in 2026 and they go, all right, cool, man. We done proved our model is successful. Right. So talk a little bit about that longevity, staying in the game, part of it, and what it takes to maneuver financially for each of these companies to really be in position at the right time.
Because I think it usually starts out with, you're constantly looking at what your valuation is.
Yeah.
As you're looking at your company performance, you're always looking for growing. And truth be told, most people don't realize a lot of companies are always keeping their ear to the ground of seeing who's interested.
Yeah.
So they're constantly building themselves to say, all right, who's going to be interested? Because there are people, to your point, that are building something to eventually sell it.
Yeah, absolutely.
And of course, position themselves, well off financially, but also sometimes position themselves in senior leadership in the company or organization that purchased them, so they can still. I've seen mergers where the owner still stayed on.
Yep.
Post merger. Still running the company that was bought.
Which is the case here, right? It's the same thing.
Yeah, it's like they still stayed on running as if it's still its own
separate
company. It's just that now you're just a subsidiary of the parent company.
Back in, I want to say this had to be 2008, maybe 2009 timeframe. So there used to be a company called 5 Minute Media. And they did these videos that was like 5 minutes. That was the whole point, right? And so they got, when you can look this up, they got bought by Yahoo, I believe it was. And when he got bought by Yahoo, he was it was like $65 million, right? Now, I would happen to be at NAB. He was doing a workshop and he was talking, and so somebody was like, man, why would you sell it? He said, I had 65 million reasons to sell it, right? I was, however many millions of dollars in debt, all of these other things. And I say that to say that a lot of people think just because you launch something that you got to hold on to it. No, a lot of times the value is in selling it, right? He stayed on board to, I think he had like a 5-year deal where he would stay on board and kind of run the division. Well, you haven't heard of 5 Minute Media since then, right? And most of us who are in the space will probably only know. But, if you think about what Yahoo has done on the video side, there's not a whole lot, right? So you don't think about a Yahoo in the same way that you think about a Google and a YouTube and those type of things. But each of these companies, I'm saying that to say they're all looking to win in that space, right? So it's like, hey, how can I maximize video? They bought what they thought was the best option at that time. Right. So if you're putting yourself out there, like, for me, when I saw even the deal with, I think it was StreamYard, that, when they sold for $250 million, we talking about a company at the time was only 9 months old. So for me, this deal makes sense at 22 billion because I saw all of these smaller acquisitions, and I'm going, well, if that's what you'll pay for that, then Roku definitely has to be worth $22 billion because if we look at the trajectory of where it's going, man, you talking a couple billion dollar company, in the future. So that's why when we look at technology, positioning your technology in the right place at the right time to the right buyer is really where you need to be. People don't understand that the developers are the ones that's spending the time making sure that the platform can handle everybody that's coming to it. Right. And so as a result, they're building the foundation of the company so that it can be in position to where it can sell. It's a proven concept. It's like one of the platforms that I can't stand right now on the technology side is Paramount, right? Like, every time I try to watch something on Paramount Plus, it's like it slows down, it stops, it's rotating. And maybe I'm the only one that's having that experience, but man, I'm like, I keep turning it off because I can never get past and being in a space, right?
Yeah.
For me, it's more frustrating probably than somebody else because
you know how it should work.
Exactly.
Right?
I know it's an infrastructure problem,
Yeah.
right? Because the moment that I close Paramount, I can go to any other streaming app and it
No
works
problem.
exactly the way that it's supposed to. So when you think about what goes into it and the time and developers and engineers and all of these things that they're putting into this, that's where the win is, right? Because a lot of those people, they retiring right after this acquisition goes through, right? They're like, hey, I'm good. You're gonna see them on LinkedIn, like, hey man, after this, I'm good for a while.
Right.
So when you look at it from that standpoint, talk about how employees stand to win, through their investments and different things like that, and how, from this merger, what it looks like. Because obviously it's gonna be like every merger. Yeah. Somebody's gonna lose their jobs, right? But talk a little bit about that.
Now, see, I haven't seen, once again, they haven't really published what's going to be the whole situation with who they bringing on, other than like the senior leader. But what happens with mergers, they're going to want to keep a lot of the people who basically made the company what it is. Right. Yeah, you might have some, some fallouts where there's, all right, it might be some redundancies with this, with this workforce or this part, but for the most part, they tend to try to keep a core bulk of the people because they know that's the people that made this thing go, made the engine go. Yeah. Because it's not like they're going to take their people and say, go run this subsidiary we bringing in. Right. It's like, no, they're just going to kind of,
not when you just put $2 billion on the line.
Yeah.
It's $22 billion.
They're going to want to keep as much as possible to keep the train on the track. Yeah. So, but they already said by year 2, they plan on having sharing the cost synergies of about $400 million. Oh, wow. Starting in year 2. Oh. So they already saying there's going to be some cost savings based on the sharing, of course, between the two entities. So I don't know how much of that is going to be as far as when it comes to, maybe staff reduction, or is it really more so because we were incurring these same costs as individual entities? Yeah, right. Now that we're going to be combined, and it's probably more so even we was already paying you to be on your platform. Right. And now the way it works in the accounting world, they're probably going to still be doing the same thing. Yeah. Is what they're going to call intercompany transactions. Got you. Because, Roku still need to be able to say standalone, we're making this revenue, even if it's coming from the parent company. Right. It's just that when Fox report as a consolidated entity, they're going to just eliminate those intercompany transactions so that they're not double counting. Right. Double counting them from the subsidiary level and then the parent level. But when it comes to the cost, that's why I say I'm interested once they actually do their annual results. Yeah. How much information they're going to talk about, what they expect to see from this merger. And then I was even telling Paul earlier, it would probably be a good thing for us to do a part 2 a year from now. Yeah. Right. To see after 12 months when they do their full annual results with Roku fully integrated, what does it look like? Because that's what everyone's going to want to see. Like, was this worth the premium price you paid?
Yeah, absolutely. Go ahead.
No. So I'm gonna go back to something as you tie into that. And you were talking about basically growth through acquisition, right? Because a lot of times,
and that's what a lot of people are doing now. Exactly. A lot of bigger companies, they still want to grow organically, but a lot of bigger companies realize it's just easier to just find somebody who's doing something that we want, or doing something that we like, absolutely, and then just say, all right, we're going to grab you and just add you on to us because we're going to help you grow, but you're going to in turn help us grow, from an acquisition standpoint.
Yeah, and speak to that on the valuation side of that too, right? Because sometimes they're looking for not only subscriber growth, but also because they're buying. We say the technology, but a lot of times it's the engineers, right? It's the people who created the technology that they also want access to that are now part of their own team. Yeah, right.
It's kind of like the human capital aspect, where it's like, and that's why because with this merger, I'm pretty sure they've been going through this probably for the past 6-7 months. Right. So it's like they've been doing all the valuations of everything. Yeah. Their assets, the people. What's the value the people bring, the work, like you said, the engineers, the technology, the patents, everything. That's going to go into the valuation of the company. Yeah. And there's literally specific metrics from a valuation standpoint that they use in order to value what the company is. But usually a lot of times when they're looking at a company's value, they're thinking about EBITDA.
Right.
And that's earnings before interest, taxes, depreciation. Yeah. It's basically your operating income.
Right.
Yeah.
And
then they're looking at that. Well, when they start looking at someone, they looking at and they like, and they do a multiple of it to see what the valuation of this company is to them, and what they're willing to pay. And then they will also kind of put it out there. They usually hire a valuation firm to do all of this for them, and then to see if it makes sense.
Gotcha.
And then once they see that, all right, this 2x or 3x multiple of EBITDA is what, is worth it, then they willing to spend the money to kind of go out and get it.
Yeah.
And then, of course, it's now going to be infringed upon them actually performing to that, to say that, yes, this acquisition was worthwhile. That's why I said it's going to be interesting to see 12, 24, 36 months down the line what this is going to actually look like. But that's why, if you're an investor, you should be in it for the long term, because you want to see.
Yeah.
It's going to take time. You're not going to expect everything to skyrocket in 12 months. That's why you want to see like 2-3 years down the line. How much growth did it add to your revenue and your bottom line?
No, it's interesting because when you think about like the whole valuation process, I think a lot of times we miss how you could set yourself up for that. Because I think something you just said, if I'm starting and, I get some noise going around me and all of a sudden it's like, hey, we looking at you and, hey, we want to reach out to you. If you don't even understand that process, right, you can undervalue your company because you don't know, right? And you just, hey, man, this company wants to buy us and they, reached out to us and want to go, this route. You might not be a $20 billion, acquisition, right? But going back to what I said earlier with, this company, I believe it was StreamYard. If they were 9 months old and somebody came in and said, hey man, $250 million. And this is, during the time of COVID, right? It's like everybody's online, everybody's doing, streaming, and
the valuation probably was through the roof because of the time.
And so for me, I'm going, man, in 9 months, how do you even position yourself to be, like the technology we know is there and all of these things, but even when we look at a Zoom, right? Zoom went from
I invested in Zoom during that time. I invested and it shot up. And I was like, yep, because everybody's home.
There you go.
As soon as they started opening back up, sell.
Exactly. Because, and that's the point, right? You can track that, you can measure that growth, right? Because you're in a period where it says
there's something there's like a cause and effect to that growth. But the thing is, when you do valuations, they supposed to take that into account. Is this kind of like a momentary thing that's causing? Because a lot of times with when valuations, they looking at the fair value of everything. So they looking at what's the price that's you can sell these assets today. As opposed to what's on your books. So then that's how they're going to start to generate what your business is worth. First, they start out evaluating your assets and your debt. They fair value it all. And then they start doing all these other calculations. I mean, it goes very deep. But that's kind of like the crux of it. They're going to fair value everything on your books and say, what is everything on your books worth today if you were to sell? Like, what is your debt worth? If you have to sell and pay off your debt, what is it going to cost you to pay off the debt? What are all your assets? If you got buildings, real estate, they're going to go out and do like a fair valuation of your real estate. The tricky part is when you have what they call intangible assets. That will be your patents, your customer list. You got to try to figure out what would be the fair value amount of that. Because those are the things that kind of go into it. Then they start building out those multiples based off of all of these fair valuations.
Because for some companies, if you're that young, that may be all you have.
Right? I mean, most of the time, a lot of times you're young, your biggest asset's probably going to be your patents, your technology, your customer relationship. They call it customer relationship, but it's basically like your customer list. And it's like those probably going to be your biggest assets when you're coming out. I mean, unless you own a building. But other than that, it's probably going to be that area where it's going to require. So even for small businesses, it still might, if you're trying to figure it out, if someone's looking to buy you, it might be worth paying, like, because a lot of these valuation firms, they probably not going to charge you a lot if you're a smaller entity.
Right.
Or you might have to go with like a smaller valuation firm to do it.
Right.
But then they will be able to kind of go through all these valuations for you and give you a report to say, hey, this is what, you know, your company is worth. So then you can have your own valuation report. So if someone's coming to offer you money, you can say, hey, we are worth at least this.
Right.
You know.
And I think that's also the problem you get into earlier to tie that in. A lot of times, like, again, we talk about the multi-billion-dollar companies who are purchasing other companies, but that can even be a strategy for small businesses, right, to grow through acquisition.
Yeah, like if you see someone that's within your wheelhouse, that's doing something that you thought about, you wanted to probably start building on your own, you might go with them and merge with them.
Right. If they already got customers, they already got cash flow, right?
And they might need, you know, just your presence or what you have. You might have a bigger presence in the market.
Yeah, absolutely.
You might have a better infrastructure than they do.
Exactly.
But they might be very great at the thing that you will want to add to your company.
Absolutely.
You can just go talk to them and say, hey, we might as well merge. We can bring you on. You can continue running what you're doing.
Absolutely.
And, you know, and even you might not even have to offer them cash. You can just offer them just a piece of your business.
Yeah, exactly.
You know, just to say, hey, I can bring you on. You know, you can get this many shares of my business, and that'll be the compensation for bringing your business on.
Yeah, absolutely. And with the major transition of baby boomers retiring, right, especially over the next several years, there's going to be a lot of businesses that could be for sale, right, and maybe even at a discount, because some of the baby boomers, they don't have family to give it to other people. So there could be a lot of businesses out there that may literally just go by the wayside. But a lot of times entrepreneurs think, you know, well, I got to start something from the ground up.
No,
well, you could go buy a business.
Yeah, I was actually talking to somebody at my church,
and
he said he was talking to some baby boomers who own like a chain of, I think, dry cleaners.
Yeah, which is a very lucrative business.
And he was like, they looking to retire and go down to Florida. So he even asked me, hey, would you be willing to help me to see if I can learn how to evaluate this thing so I don't overpay? But I brought that up to your point where that was someone who was thinking that I'm looking for some additional streams of income. The baby boomers are like, we done.
Right.
We're relocating to Florida. I mean, I don't know why, but no offense, Florida. I know you just got some issues with insurance companies and properties and stuff. So
right.
But you know, but
the weather's nice.
Right. No state tax, right? But there's a few benefits.
But he was like, you know, he thought about maybe just buying their business instead of just building something from scratch. And I was like, and to your point, that's an example of someone saying, there's people who's retiring with, they got a sustainable business. They just don't feel like doing it anymore.
Yeah. And that's a good point too, man. I think, you know, if the exit strategy, because that could be part of your exit strategy, right? Hey, man, this is my retirement plan. I'm going to grow this business, lead it, be successful. And then at the end of the day, my plan is to sell it. And even in those situations, you still have opportunity for somebody to stay on as an advisor, right? For a certain period of time to get you through it. That's kind of what Andre did when he sold the UPS store. You know, he stayed on for a little bit, helped her to get through sort of some of the, you know, learning curves and those type of things. And then he moved on. And you can build that into the sale, right? Contract, how that's going to work financially for you. And then you have some people that will sell and they'll do it on time, right? Where, you know, over X amount of years, the business pays me back this much until you pay me off. So it's kind of like owner finance, if you will, type of situation. So I think those are opportunities that people don't often look at.
But the thing is, even one of the companies I work for, they did exactly that. They sold one of their businesses. It was basically they sold their business. They got some cash and they got some stock in the company that bought it. And then on top of that, they provided transition services for 24 months.
Nice.
Where the entity was paying them
to
kind of help them transition the business and integrate it into their business for 24 months. So they was recording transition revenue for 24 months just by doing the same thing they did when the company was under them.
And these are all things that's important because, like, I think about it like this, going back to getting a $12 billion loan, right?
Mm-hmm.
If you go and say, hey, this is my plan and I want to start from scratch, you don't have a track record at all.
Right.
And you go into a bank and saying, you know, this is what I want to do versus, hey, I'm looking to buy this company. Yeah. This is where it is right now. This is the valuation of it. This is what we can get it for. Going in and asking for a loan, then you have a little bit more leverage, right? Because you're showing them that there's already assets built into this. Talk a little bit about, you know, about that from a strategy standpoint, a little bit circling back, but on a smaller scale of how people can look at. Because I think a lot of times when you hear people say, yeah, I want to be an entrepreneur, I want to be an entrepreneur, most people are always trying to start their own thing, right? As opposed to looking at what might be existing out there.
But see, the biggest thing that people should think about is you can go and start and spend all this money on your own.
Yeah.
It may succeed, it may not.
Right. Yeah.
As opposed to you spending the same amount of money on something that's already succeeded.
Right. Yeah.
Even with the Fox thing, they could have probably said, yeah, we're going to hire the engineers and stuff. We're going to build this thing from scratch. We're going to build something that's cutting edge, that's going to compete with the competitors and beat the competitors. Yeah. You may think that. And you may actually, you know, go out and try to do it. Yeah. But there is a chance that it might not be as great as you thought it would be.
Right.
And then you can't compete, but you spent all this money trying to.
Yeah.
And then now you still got to deal with paying off this loan that you probably got to try to build a cutting edge platform on your own.
Yeah.
Instead of, you already got a cutting edge platform that's been successful for how many years? And probably they're still probably building upon their success and, you know, and getting better at what they do.
Yeah.
And it's like, and to your point, the banks will be like, oh, well, yeah, I'm looking at their financial statements.
Yeah.
They've been doing well for how long?
Yeah.
And you trying to buy them, and you've been doing well for how long? And you going to integrate them?
Yeah.
I think that's a win-win for everybody.
And think about like that part too, right? Because most banks, right, you got to be in business 2 or 3 years at a minimum, and then you have to have really good financials.
Yeah.
Right. As a business, even get a loan. But if you're going to buy a business, right, they're basing it.
All you gotta do is bring them their financial statements and saying, "This is what I'm buying.
Exactly.
This is," and show them the valuation report. This is what the valuation of this company is. This is what I'm going to pay for them. I'm looking for funding. This is how much I'm putting in to purchase, and this is how much I need from you. And then they're gonna be like, they're gonna go over everything. If it looks solid to them, they're gonna say, okay. Because the only thing they want to look and see, are they performing well? Well enough for you to be able to make your interest payments?
That's
the bottom line is, are you going to be able to make these interest payments? Oh, you will.
Yeah. Absolutely. Just know what other topics you want to hear us talk about. But this is The Profit Formula. I'm Mike Upshaw.
And Paul Wilson.
And that's
James Peterson, the resident CPA.
That's right.
There we go, man.